Get deals done today, I think you got to be creative, especially with the insurance. You got to team up with bigger management companies, I think, that have master policies that can kind of have a global insurance policy to be able to help pencil these deals and make them work for you.
Welcome to Deal Flow with me, Michael Pulio, the go-to destination for private equity and real estate professionals, including institutional investors, sponsors, and market experts. Each week, I talk with industry insiders on everything real estate, capital, and prop tech. Joining us today is Ken Wellar, a distinguished leader in the multifamily real estate sector and the founding partner of Global Real Estate Advisors, GREA. Ken brings a wealth of experience to the table, having transitioned from his successful tenure as a managing partner at Rittenhouse Realty Advisors to spearhead GREA. Under his leadership, GREA is dedicated to maximizing value for both private owners and institutional investors through innovative, thesis-driven investment strategies. Before establishing GREA in 2022, Ken expertly managed over $3 billion in transactions, covering the sale of more than 28,000 units at Rittenhouse Realty Advisors. His comprehensive expertise in brokerage services, financing, property management, and development, combined with active roles in several key real estate councils and institutes, positions him as a pivotal voice in the industry. Today, he's here to share insights in the evolving landscape of multifamily investments and the strategic role of private equity in real estate. Ken, thank you for taking the time to be with us today.
Yeah, thank you, Michael. Glad to be here today. So thanks for having me.
Yeah, absolutely. So I know I gave you kind of a little bit of a spiel there on your background, but I'd love to hear it right from your mouth. If you wouldn't just give us a quick, 2 to 5 minute rundown of your career and kind of what you're focused on today.
Yeah, no, thanks. I started my career basically in college, kind of how I see a lot of my clients, investors start really buying little row homes, fixing them up, selling them, $30,000 row homes that I would spend 10, 20,000 and sell or rent. I did that my senior year in college. I did that for a couple of years after college. Got a job right out of college selling insurance, long-term care insurance, and it was a good way to learn sales, but wasn't really the field I liked, and mutual funds. So it was a good training in like how to make a lot of calls, how to sell. But I loved real estate, and I wanted to learn about commercial real estate. So at the time, one of the national brokerage firms just was opening an office in Philadelphia, and they were a group that said I didn't really have to go underneath anyone. We have a nice training program, which jived well with me. So I was there for about 8 years, and really enjoyed the experience there and learned kind of the multifamily brokerage business. And at that time, one of my competitors, Corey Lomberger, we would compete all the time, said, why don't you come over to my firm and we'll work together for a year. So we did that for about a year until we broke off and started kind of a regional boutique firm called Rittenhouse Realty Advisors. We had a really nice run there for about 9 years, really focusing on middle market institutional work in the Mid-Atlantic. So we work on deals from Maryland, New Jersey, Delaware, Philadelphia, all throughout Pennsylvania. We carved out a nice niche in student housing in the Northeast. We're one of the few firms that was doing a lot of student housing in the Northeast. The student housing was really taken off and big, the prior 15 years, really big more in the Southeast, but no one really focused on in the Northeast. So we hit a nice little niche, and we were doing a lot of deals in the Mid-Atlantic region. It was about 8 years into our business where we got approached by another national firm. They had a brokerage company, but their main business was providing debt, and they were trying to build out an investment sales platform. And at that time, we negotiated a deal for about a year. This company, it didn't work out. They ended up getting bought by another, one of the top 3 national companies that bought, 40% of the company. And basically, they owned only about 2 of the investment sales shops, and 5 of them were independently owned. So we got to meet and collaborate with these guys for a year, and they didn't want to go over to the national firm. And we basically created GREA that way, where we said, hey, why don't we create a new platform. We were doing a lot of stuff on the student housing side nationally where we didn't want to, we were kind of competing with kind of the CBREs, JLLs, and we kind of needed more of a national platform. So we thought this was a good opportunity to kind of create a new brand and new company. And, all the guys who were kind of on the original platform, all have, 15, 20 years experience on the investment sales side. So we set up a similar model than I would say, if you remember ARA. So we kind of all stayed independent, but branded and rebranded under GREA, all collaborating and working together, selling multifamily properties. So we had, out the gate, we started out in obviously Philadelphia, our mid-Atlantic region. We were in Detroit, Atlanta, and then Dallas and Houston. They were kind of like the main guys that started it. And then from there, we added the Deaton team that's in the Carolinas, Ariel Capital in New York City, who has a big team, and HFO in Portland, Oregon. From just a collaboration of like-minded guys, we kind of grew the platform in a short period of time. And, we've been involved in about 13 billion in multifamily sales in the last 3 years in this down market. So kind of evolved from a little, 3 guys when we started our firm to, I think we're up to like 150 investment advisors on the multifamily side across the country and growing. So it's been a fun ride, a lot of bumps and bruises along the way, but learned a lot and have a lot of great relationships across the country, through clients and other brokers I've worked with throughout the United States. And it's kind of how I got to where I'm at right now.
Awesome. Well, there's a lot in there. So I was taking some notes as you went. You're based in Philly, is that right?
Yeah, based in Philly. I actually moved to Miami. I split my time in Miami and Philadelphia. So
Okay.
I'm there.
Very good. Very good. I actually, also started my post-college, my real estate journey buying in West Philly and in Grace Ferry and Point Breeze and various neighborhoods for the, you obviously know these areas, but, various little neighborhoods in Philly buying row homes for $20,000, $30,000, $40,000. And, time goes by since then. Not doing that anymore, but it's, it was a good market.
Yeah, but it's a good way to kind of learn the business, honestly. And if you make mistakes, you're not going to bury yourself along the way. You'll rebound, but it's a great way to start. I always tell guys, like, if you're not in real estate, like, start small, smart. You see if you even like it.
Better to make a couple $100 mistake or a couple $1,000 mistake than a, $100 or $1 million or $10 million mistake, right?
Correct. Yeah. At least I've seen that along the way as well.
Yeah. So, that's quite an interesting story. I think you mentioned some kind of bumps and bruises along the way. I wonder if you'd be kind of anything that comes to top of mind that, so far as stories around getting this platform up and running, it's been you said $13 billion worth of sales going from 3 people to over 100 all across the country, quite quickly from the timeline. Could you maybe describe that? Maybe you have a story there, or just anything you could speak to around the scaling process of going from just a couple people to 100 plus people, and just the coordination effort of getting all of those people to kind of work and kind of row in the same direction.
Yeah, I think it's important to have just like-minded people you trust, believe in, good integrity, and people you enjoy working with and building stuff with, and, partner up with different guys in different markets, kind of just greenfield into a market, try to learn a market. It's going to take you like 5 to 10 years. It takes time. So I think it's key to really know, real estate's a local game, and having people, boots on the ground, people who've been there for years, relationships for years. I mean, it goes a long way. And deals come out of relationships from someone they know, from literally working together at their first job to, high school, you just don't, so I think real estate more than anything, any other industry is local knowledge is so key. So I think it was key for us to kind of partner up with different guys who mastered the market for the last 15 to 20 years and were really the go-to, top 1 or 2 or 3 investment sales teams in each of their respective markets.
Mm-hmm. So it was really about finding that right talent who had already, kind of proven and learned the markets. And then you guys essentially recruited those teams to join your platform with a, kind of an offer they couldn't refuse, give them more independence, more.
Yeah, exactly. We wouldn't want to be like 100% corporate, but also give, more of a structure, but have a national brand, but also to kind of allow people, and real estate's a very entrepreneurial business, not take that away from each of kind of these founders and of each of these markets. So they have that independence, but and also have the opportunity to build something. That was intriguing, and I think that's really been our pitch.
Yeah. I guess, let's talk a little bit about you have, that's a lot of transactions to complete over what is like been a very tumultuous, volatile, ever changing, market these last, I don't know, now it's 4 or 5 years, between pre-COVID, COVID, and then post-COVID. Seems like we're talking pre and post COVID these days is kind of the idea. Maybe could you speak a little bit about what you're seeing in, how the market evolved over that period of time, or you could speak to just what you're seeing in the market today. But you have a unique perspective of being able to speak to how the market was behaving during this, very unusual, not just and when I say market, I mean buyers and sellers and people, right? How are these people behaving? It was a strange time. I'd love to hear your perspective on just the COVID experience and then through today.
Yeah, I've been doing this for over 20 years, and I feel like this has been like the last, say, 18 months been a very challenging, one of the more challenging markets I've seen. I just remember, when COVID happened and we were, the market was going gangbusters, and then everything just like stopped. And I mean, it was like 6 months, and if we could get anything done, that was like a huge win. And then it went from stop to like literally going on a treadmill and running up, 100 miles per hour and not stopping. And that went on for, a good 18 months to 24 months. And just everyone's just guns blazing, trying to get stuff done as much as possible. And then it was such a dramatic, a huge shift on, when we were getting deals done where debt was about 3.25. We were seeing it even below 3%. Yeah, I think it was in the middle of March. We were negotiating on a lot of large deals. And then, we're about to go hard on a few different deals, and rates are bumping up 50, 100 basis points in such a short time period. And that short run, it was like guys were trying to hold on, try to get deals done, but they, all these deals were starting to blow up. And then you saw such a wave of buyers who were buying deals on bridge loans, and they were just whatever buyers could do. They were just however they could put out capital. Money was flowing so much. It was so easy to raise capital for a lot of these syndicators. A lot of the syndicators were kind of driving the market, and kind of where we're at today is a lot of these guys have loans maturing, and now a lot of the equity's kind of wiped out, or not. They have to either refi and survive another day, or kind of take a hit. A lot of these syndicators, we've seen, you got a lot of smaller investors, $50,000, $100,000, $200,000 investors who come into a deal. You try to go back to them and ask them to put up, 50% of the original investment. That's a hard ask. So we're seeing a lot of guys that are kind of not in a great spot right now. I would say the only other time I've seen the market this tough was probably 2009, right? Just right after the Great Recession, the beginning of that, 2009 and 10, where there was like literally no capital. There was a lot of REO deals. You were selling a lot of REO deals, but there wasn't any capital. Today, there's plenty of capital. It's just there's still a good disconnect between buyers and sellers where the spreads are on where deals can get done. Most aggressive buyers I'm seeing today, they want to be at least, where your debt is to kind of where their cap rate going in is. So bar at 5.5, they probably want to be closer to at most aggressive if there's upside 5.5. And a lot of these deals in different markets, especially the Southeast, these were trading in the 3s to low 4% range. So you can see kind of how quickly the market changed. I definitely I've never seen in my 20-year career the market move so quickly with rates. Even after the announcement of the 50 basis point cut, the rates actually went the opposite way. So we see a big run up on the 10-year here in the last couple of weeks. So it's been an interesting market. It's been challenging. I mean, I feel like after Labor Day, I feel like there's been a lot of groups like want to do deals. Some people have to do deals, either, even if they don't want to sell, they just have to make things happen. They've been selling some larger REO deals as well. Doing some short sales, getting creative, doing a lot of pref work. Guys coming out of construction during lease up, seen a ton of guys who went over budget, where basically COVID costs, everything costs more, time took longer to get projects done. So there's definitely just guys out there hurting for sure.
Yeah, and there was a lot in there. I think the most recent, the last thing you said around, newer deals where, people were building to a certain yield on cost, and that yield on cost is sort of maybe fair market value today, or maybe not quite even, right? Maybe they're through fair value. And so even the newer deals, I'm seeing a lot of people maybe think that there's opportunity there. Is that, maybe that's a good place to go next, is just, there is stress all across the vintage curve, depending on what market you're in and what you bought it for and your time frame, the financing issues that we mentioned, and we'll get into all the specifics. But where do you think is like since you have such a look across all these markets and all these vintages, where do you think the best opportunities are today from the perspective of maybe location, not specific necessarily, but hey, we think that the Southeast, new construction, if you could buy it at cost, is a great opportunity? Or where are you seeing most of the stress where you think it makes sense, right? Because sometimes there's stress and there's good reason. You don't necessarily want to buy in some areas where people are over their skis, but in other cases, it's just, hey, bad luck for when they bought it and when they developed it, but it's the next person's win. So kind of where do you see those opportunities today?
Yeah, it's a good question. I mean, I think you got to pick and choose, and you really have to do your due diligence and look at it in a market. I think one of the big things that happened was a lot of markets got overbuilt, a lot of units coming online, cash was flowing. You were building, to your point, low 5.5 yield on cost for new construction. That was not a problem to capitalize deals today. You can't even get an institution or LP to look at a deal at least at 6.5, 6.75 to 7 they want to build to. So basically, development basically stopped for new construction deals. So I think it's important, when you pick and choose the markets you're looking at, where is the opportunity? The opportunity could be in a market that there's not a lot of new building. The guy just got caught and their investors just went out of the deal. Guys who maybe bought in 2021, early 22, they bought it on a bridge. Their debt's coming due. Probably, get it at maybe below, their basis. They maybe, I've seen a lot of guys execute on their business plan, but unfortunately, where rates went to, they're still wiped out on their equity. So I think you gotta pick and choose, and look at kind of what's going on in that submarket and how many units are coming online. Where's the jobs? Most importantly, where's kind of the population growth, and where's the rent growth? I think a lot of markets have kind of been flat or negative or concessions. So you got to really factor that into your underwriting, is understanding what the real concessions are. Where do you really think the rents are going to be in the next 12 months? And what's behind this? The good thing is, I don't think you'll see a lot of product being delivered after the next 18 to 24 months, because a lot of projects have just not been able to get off the ground. So I think you got to look at what's kind of behind you, and that there might not be a lot of deals behind you that you have to compete with.
Yeah, I think to your point, the new deals, right? If you don't have absorption issues and risks, now isn't a terrible time to get into that deal with limited deliveries coming, right? If that absorption isn't an issue and you still are constructive on the demos and the population growth and the and the overall area, because you're not going to have a lot of competition a year or two from now. And so while it doesn't, it's always darkest before the dawn, so to speak. So I think there is, and I think that's the thesis of a lot of folks, is like, hey, I can up quality, I can up vintage, and I can get kind of the same going in cap, and I'm not going to have a lot of competition in a year or two, and I'm better positioned than a 90s asset. And then I think the other kind of thesis is maybe more of the basis play. that you described of, hey, I bought for a 70s deal at, the prior guy bought a 70s deal for $1.75 a unit. Now it's worth 140. My debt's at 155. I've lost 50 cents of my equity essentially as the current owner, and now maybe 145 is a good number for that. Although I'm seeing a lot of deals like kind of in between where it's sort of, for those older deals, it's unclear who's really in control, right? Because if you can't, as a sponsor, you can't sell below the debt, right? So if fair value is 145 and your debt's at 155, you think you're making decisions, but in fact, you're just kind of a dead man walking. And so are you starting? But that seems to be a very slow process. Psychologically and bureaucratically. Where are you seeing that? Because I'm sure you're talking to owners all the time who are in various stages of grief. Maybe is the term is like, oh, well, we're just gonna raise $1 million of pref and we're gonna get through it. And then 2 months later, they're in foreclosure. So maybe you could speak a little bit to what's going on in the older vintages that maybe is an opportunity for folks.
Yeah, I think we're finally starting to get to the acceptance period where some of these owners who bought a couple years ago kind of like, this is the new market. Like, hey, I have to accept this. What can I work out with my lender? If I need to truly get out, I can't recap this deal. I can't prep this out. Like, let's move on. Let's work out a deed in lieu. We're starting to see that. There was definitely a lot of guys who thought, the market would come back or waiting for rates to drop. The 50 basis point drop, that's going to be the savior. We're having the opposite happen right now. So I think we're starting to have these real conversations with guys. All right, what do I need to do just to get out? I'm ready to kind of move on. Or got a deed in lieu, hand back the keys. Like, these are all things that are happening real live time today.
Yeah. No, I think, and so I think that in the vintage, space, the opportunity is going to start to become, conversations with the lenders, right? Effectively, versus necessarily the sponsors, depending on how far along it is.
I could tell you like this 2021, 20, 19, like, the 1970s, 80s value add, like that was the hottest thing going. Today, it's very hard to sell those deals today. Everyone wants a discount. Buyers are smart, they're savvy, they understand what's happening in the market. So, I think the opportunity for a lot of buyers now, like, how can I buy the same 2010, 2015 product at a same type of basis and same type of return, but just newer product? And we're seeing a lot of kind of buyer shift their buying mentality to the newer product.
Rolling up quality, so to speak, right?
Especially with insurance too. A lot of the insurance has been a real issue, especially in the Southeast. Just making these deals not pencil for buyers. The sellers are underwater. So that's been one of the big trends we've been seeing as well. Just how to handle insurance.
Do you guys, I'm not sure if you said that I know this is sort of like a nationwide issue and it's a coastal being anywhere within 100 miles of the coast. But then it's very much a Florida issue as well. I don't know. Do you guys operate at all in Florida?
Yeah.
You're based there, I guess so.
Yeah. We do a few deals a year. We're selling a couple deals right now there. We've been doing a lot of underwriting deals, and we're seeing some insurance premiums from $1,800 all the way up to $3,000 per unit for insurance. It's just insane. I mean, you look at other markets. I mean, that's what taxes are for some of these bills.
I remember when I was placing insurance at $250 a unit in the Midwest, and even there, it's double or triple that at this point for vintage properties. And we've had a number of deals blow up as a result of trailing insurance was $1,200, and quotes were $2,600, like you just said, and you're like, the seller can't make sense of it because they're like, well, I'm just going to hold it for the difference in that insurance, the value to move to a new owner. You're destroying value from the transaction essentially. So it's tough to make that happen. Do you have any inside baseball on when that's going to relieve? Oh, go ahead.
Yeah, we were starting to see some relief right before the last two hurricanes. I think rates were dropping 15, 20%. We were starting to see some good relief. And then, who knows what's going to happen over the next 90 days now after these two major hurricanes. But I mean, to get deals done today, I think you got to be creative, especially with the insurance. You got to team up with bigger management companies, I think, that have master policies that can kind of have a global insurance policy to be able to help pencil these deals and make them work for you.
Yeah. Yeah, no, it's definitely a tough one. Obviously, like, you mentioned that we've seen a bit of a rollover in rent growth in some of the hotter markets, perhaps due to, a lot of new development and deliveries. In today's market, where do you think clients should be thinking about, putting capital or buying properties? And where are those places where we still see good population growth, we're still seeing good migration, and we're also perhaps seeing still the expectation of continued revenue growth?
Yeah, I mean, I think it's sub-market specific. Like, where's the jobs? I mean, I think jobs is going to create population. I know, New York's coming back pretty hard. I think I look at beds and eds as well. I think that's important. Follow the hospitals, follow the education systems. Where the schools. I do a lot of student housing. I head up the GREA student housing platform nationally. So we're working on selling properties across the country and kind of where the enrollment growth is. I think part of student housing is how the schools are doing. The biggest thing is, as an investor, where's the enrollment growing? And that kind of stems from looking at a state and just the population. Where's the population trends of that state? Holds true to multifamily as well. Just where's the population? Where's the growth? Where are people moving to? And where the jobs are? I know we're seeing a ton of action in the Carolinas. I think that's been one of our most active markets. Just seeing just a lot of the jobs. Just a lot of, if a deal comes up, we're typically selling a deal. If we take a deal out the market in the Carolinas, just the amount of kind of rent growth because of the amount of population is big. Obviously, Florida was big for a long time. Still looking at a lot of jobs, a lot of people moving to the Sun Belt states, Texas. We're super active in Dallas and Houston. And I think the most important thing is really where the jobs are going. And then I always fall back on universities and healthcare systems. Like that's always an easy thing to point out, just like how close are you to hospitals? All the work I've done in Philadelphia. I know some of the biggest drivers in Philadelphia are Penn, Jefferson. Like, these are the major employers of the city. I know in New York City, same thing. Where most of the jobs, besides finance and besides finance, it's surrounded by the schools and the healthcare systems as well.
Yeah. So I like definitely healthcare education, a little bit more secular, right, versus cyclical. And if you make sure that you're checking those enrollment numbers and everything and the support and then the path of progress for out of those hospital systems and out of those the schools.
It's not as sexy as some of the other job sectors, but it's steady and it doesn't have the kind of ups and downs other sectors might have, but it's steady and it's I could tell you in some of the best student markets, we're still seeing 7-8% rent growth in some of the tier 1 markets.
Yeah, and is that I guess, yes, switching to student housing for a minute, what's driving that in your view? Is that, hey, we've got kids want to live off campus and the parents are paying and there's a little bit of a principal agent problem there, or how what's driving such increases in rent in your view there?
Student housing more than anything else is just very that market. Like, you can see a tier 1 market be great 3 years ago, and today it'd be a soft market because it was overbuilt. I mean, there's some of the biggest developers in the country are student housing developers, and if they have the capital, which is I think the capital in that space is pretty free, more than even multifamily today. Just, you're seeing big projects being delivered in some of these market, like 2,000 bed projects, but some of them are leasing in 90 days, 2,000 beds. Like, it's a matter of the demand. Like, you have a lot of older products. It was hard to develop in some of these markets, and you have a lot of smart developers where we're able to figure out how to get these projects approved and developed, and they're leasing up super strong. And you're seeing enrollment growth in a lot of these markets, and there's nowhere to live. So if there's nowhere to live, what are you going to do? You're going to push rent on the existing inventory, and that's really pushing the market. It's just the enrollment growth. And that's one of the main kind of economic drivers of how you're able to drive these rents is just the enrollment. And I think there's been some consolidations. I think some of the smaller schools have gotten hurt post COVID. Some of these schools shutting down, consolidation has helped some of the bigger brand name schools. The power four markets. I think that's been a really driver. I think sports, NIL, all these factors are helping kind of drive the brand recognition of these schools and driving enrollment. And I would look at kind of where's the migration of population, which states, SEC, it's such a, huge driver in the Southeast. Again, it's like, that's where a lot of these kids want to be today. So you got to really look at what are the trends of these schools and what's the enrollment, but we're still seeing big rent growth in a lot of markets that were overbuilt. But again, you got to be very careful, and you got to look at the trends and look at the pipeline of what's being delivered in these markets and what's behind it. Because a market could be great for 2 or 3 years and could get overbuilt and get pretty soft pretty quickly.
Yeah. And so it's that enrollment growth, which right now is largely being driven by, the kids and where they want to go to school. And a lot of that has to do with the sports and the amenities that the school has, whatever those might be, right? Which includes the housing, right? The schools need the housing.
I think a lot of these schools benefit from these developers doing their own, putting their own capital, putting high-end amenities and in these schools. Some of these schools never had a purpose-built student housing property before. And that's, when you're a student, you want to live in a nice facility. I remember when I was in college, I was living in a row home in North Philadelphia. Like literally, we had no heat. Like our oven was our heater. It was a different time, but it's pretty fun to watch kind of the how student housing has really evolved into just some of the best products, some of the best celebrities in the country, or some of in these like tier 1 markets.
Mm-hmm. Yeah. Do you see, speaking of drivers, I think, do you see I guess AI and the requirement for compute and data centers driving jobs or people kind of looking for deals that are kind of drafting off of, the need for more maybe energy or more compute or light, like, warehousing for these GPUs and things like that? Are you seeing clients, trying to find properties like that?
Seeing a lot of clients shift what their focus was, and data centers that's been big, near power centers. You're seeing a ton of, what do I do in this cycle? Where do I see the opportunity? And yeah, that definitely data center has been a big topic and I know a couple of my really good clients have made a lot of money already and big pops and just getting in early.
Yeah. So as we're kind of getting here to the end, I think I just had one of the things you said kind of earlier in the pod here was around how people are looking for the finance, the cap rate going in to be a little bit above or equal to the financing rate, which I think some people are calling positive leverage. I'm not sure if that term exactly describes that, but it's certainly something people are saying. It seems like a lot of what happens in at least the multifamily market is driven by what that, financing rate is, right? It's, as the financing rate goes, so does the cap rate on the purchase. It wasn't always like that, right? There used to be a spread.
Deals. Yeah.
There used to be a spread between what you'd finance a deal and what you'd buy a deal for. And it seems like as there's been more and more liquidity in the space on the equity side and maybe lower expected returns, people have been able to justify getting down to basically a zero spread or a 25 basis point spread, justified perhaps by the fact that they're going to get to a higher cap as they develop the value add plan or something. But, could you maybe speak to that a little bit? And you think that that's here to stay? Do you think we're going to be, I assume that when this market changed, we would see a lot more differentiation in caps. But it does seem that even still, we've got a pretty tight range between vintage, location, all drafting off of essentially that financing rate. And if we saw that financing rate fall 200 basis points, we might be right back where we were before. I'm not saying that's going to happen, but there's seems to be something going on there. Do you have a sense of what that is, or kind of what in your career, how that's changed?
Yeah, I think a lot of buyers, developers, I think everything goes in cycles, right? And I think people have short-term memories. I think it'll be, probably another 2 to 3 year cycle. I think we'll be at least 18 to 24 months where we'll be kind of where we're at today. But as kind of rates come in, people have to deploy capital. One of the best ways to deploy capital is in real estate. So I think competition, I think you'll see people get wiped out of this market, and it happens in every cycle. And I think you'll see you'll see more activity definitely first, second quarter. I think you'll see a wave of things that have to be flushed through the system. They got to get sold, have to get out. Guys going to take hit. There's going to be definitely winners and losers in this market. And I think there's just going to be opportunities. So you just got to keep your options open. Look to see how you can add value. Look at the submarket. Look at kind of the economic drivers, where are jobs, where's the population growth, and how can I create value? And I think real estate's a block and tackle sport. You got to know kind of do the fundamentals. If the deal doesn't pencil, doesn't make sense. Doesn't make sense. You can't. I think back in 07, 06, a lot of people got hurt and just kind of finance deals to make them work. And we've seen similar situations happen in this cycle. So again, just got to have these deals flush through the system, or it's a cyclical type of market we're in right now, and I think it'll flush. Things will flush out, and I think it'll get competitive again in a few years.
Yeah. My just one more last question, kind of tagging on to another thing you had said earlier about the market being similar, or maybe I think you used the word similar to 09. I think one of the things that I think happened in 09 was people bought deals in 09 that thought that they were buying at a great price, only to lose them again. And then it was the buyers in 2011, 12, and 13 that actually came out ahead. Just as a parallel to that market, do you feel like we're getting to the pricing necessary to truly flush out, and bring in that new capital, or do we have another leg to go here where the people who are going to be buying deals today in 6 months from now are going to be still fighting, treading water, fighting against, some of the macro environment, and the revenue growth issues and the expense growth. Where do you think we are in that kind of bottoming cycle, I guess?
So it's definitely a tricky market. I think it's important for buyers to keep their fundamentals, keep their, make sure the deal pencils, make sure it underwrites, seeing buyers be definitely more conservative on rent growth, and they're trying to get positive leverage, right? So they don't expect to get much rent growth. How do you make money on a deal? You kind of have to buy a deal at a higher cap rate than the interest rate you're borrowing at today. So I think leverage is important. I think sticking to fundamentals, being a disciplined investor. Most buyers I talk to, they have to underwrite 100 deals and make one deal work. Maybe today it's 150 deals and make one deal work, and it's probably even more. The buyers that I talk to are pounding their head against the wall trying to make deals work. But I think it's important, if you're not disciplined, to your point, someone could get hurt. They could buy too early. They think, oh, this guy just got wiped out. I'm still, I think this is a good buy, but their basis could still be high, and it still doesn't pencil. And again, I think it's very important to really look at what concessions are, because concessions could really make or break your deal, and what the true numbers are, and what the average in place rent is actually today. So that's important to look at.
For sure. Yeah. Well, Ken, I appreciate this. I guess, is there one last kind of golden nugget or anything you want to leave the listeners with as it relates to the market today, or anything you want to share about just something maybe you live by or you work by, you've been very successful through your career? Anything you want to leave our listeners with here?
No, I think the best thing about this business is relationships, and working with people over and over again, and work with a trusted advisor. Please reach out to anyone on our team nationally on the multifamily side. I think knowing your submarket, knowing what's happening in that submarket is so crucial. Just know the players. I think in each of these submarkets is really key. So working with people that you trust, integrity, get deals done. You could have a long career, and I think you got to look at this as a long-term play and not a get quick rich type of scheme. Like real estate is a generational type of asset. The guys who are the most successful people I know are looking at things 10, 20, 30 years for their kids and grandchildren.
Yeah, I think that was a lot of good stuff in there. A lot of good work with people for a long time, build relationships, act with integrity, know your markets, know the ground game, and be in it for the long term. And that's a lot of really good lessons in there. So Ken, thanks so much for your time and for sharing some great insights and knowledge with in the real estate space. If our listeners wanted to get in touch and find out more about you and your team and work with you, what's the best way to get in touch?
You check out our website at www.grea.com. You can always reach out to me on LinkedIn, Kenneth Wellar, or Instagram, Ken_Wellar, WELLAR_CREA. You'll see a lot of our deals there. But our website shows a map of all our locations, our advisors in each of those markets. And then feel free to reach out to me with any questions. I'm happy to help.
Awesome. Well, thank you, Ken. And we'll make sure to put all of those little things in the whatever they call those things in the show notes, and so that anyone could just click on those and get in touch with you. So great. Thanks for tuning into this episode of Deal Flow with me, Michael Pulio. Don't forget to give the podcast a follow on Apple Music and Spotify, and subscribe on YouTube so you don't miss an episode. And of course, if you feel like someone else would get something from this show, please go ahead and send it across to them. Feel free to comment below with regards to featured guests you'd like to see on the show, or get in touch should you think your knowledge or expertise would make for a great episode. Thanks again for me, and we'll see you on the next time on Deal Flow.